What if I told you there's a perfectly legal strategy that could potentially save you $455,000 over taxes in just the next number of years on a $1 million investment? Now, what if I told you that most financial advisors either don't know about this or aren't offering it to their clients? I'm Nathan Crampy, and I'm going to share with you a strategy that I call Tax Alpha, and it's been quietly revolutionizing how many wealthy families are managing their investment portfolios. You see, this isn't some sketchy tax avoidance scheme. It's a sophisticated investment approach that many family offices are now offering their highest net worth individual clients. Here's the thing, it really gets me fired up that this is about business. This is about all of these different elements that we can be doing. And I have been working in this industry in business for 2 decades, and I help business owners and retirees just like you maximize their wealth. And I can't tell you how many times that I've seen people paying way more in tax than what they need to. See, just this last month I was reviewing a portfolio for a retired business owner. Let's call him Robert. And he had built a $3 million portfolio over 30 years. He had a great success, but when we dug into his tax situation, I realized he was potentially leaving hundreds of thousands of dollars on the table every single year. You see, Robert's situation isn't unique. And if you're watching this video, there's a chance that you've been successful. And maybe you've built a business, maybe you've been a diligent saver and investor, and maybe you've received some company stock or inheritance along the way. But here's the challenge that comes with all of this success, that there's more and more room. As your investments grow, that Uncle Sam wants to take his share. And it's like most investors, you're probably sitting on some highly appreciated stock that you're afraid to sell because the massive tax bill that it would create. Well, today I want to go through some of this and share with you something I call Tax Alpha, and it can help you keep more of what you've earned while still getting the diversification and the growth potential that you need. You see, this isn't just theory, and I'm going to be walking you through real examples and show you how this actually works. So let me tell you about 3 unique client scenarios that I've come across. Scenario number 1, the concentration stock problem. You see, I'm going to call her Margaret, and she is 62, and she's recently retired from a tech company where she's worked for 25 years. And over these years, she's accumulated about $800,000 worth of her company's stock through her employee stock purchase plan and part of the 401k as well. Well, here's the thing. The stock is now worth $2.1 million. The bad news is she has a $1.3 million unrealized capital gain sitting there like a ticking tax time bomb. And Margaret knew that she needed to diversify. You see, she had about 60% of her retirement portfolio in just one stock, and it was keeping her up at night. But selling everything would mean paying over $300,000 in capital gains. And yes, there are a lot of different elements that went into this, but she could immediately feel that trap that she was thinking about. Well, then we have scenario number 2, the successful business owner. And this, I'm going to call him David. He sold his manufacturing business 3 years ago and took some of the proceeds from that acquiring company stock as part of the deal. It was a smart move because the stock has doubled, but now he's got the same problem as Margaret, just bigger numbers. He's got a $4 million highly appreciated stock that he wants to diversify, and he's looking for a potential tax bill of over $600,000 alone. Well, our scenario number 3 is the inheritance dilemma. You see, this is where we're going to be talking about Linda. And Linda inherited a portfolio from her parents, and it included some individual stocks that they've held for decades. Some blue chip companies, great performers, but highly concentrated now, and had a massive appreciation. Now, she wanted to honor her parents' legacy while being smart about the risk management and taxes. You see, that's where this comes into play, and why we want to look at how these strategies can work now and how they can work to benefit you. There's traditional financial advisors out there that would give some of their clients a few options. And frankly, none of them would be great in these scenarios. You see, the first option that they would give them, and maybe you've received the same bit of advice, is just to hold on to the concentrated position and hope for the best. But that's not diversification. That's called gambling. And you've made your wealth by getting concentrated stock. You want to stay wealthy through your diversification. Well, here's the second option that many financial advisors would give their clients. Just bite the bullet, sell and pay the massive tax bill, and then move on. But who wants to write a check to the IRS for hundreds of thousands of dollars if they don't have to? Especially if we're looking at the different options that this could be used for. Sometimes I've even heard financial advisors say that, oh, you're wealthy enough, you can just pay the tax and move on. That's not a good option. And you should be able to retain the money instead of going to taxes. So you can use it for the charity, the events, the family legacy that you want to use it towards. Well, then we have option number 3 that many financial advisors give their clients. And this is sometimes using complex strategies or even trusts that are out there to try to diversify away and really do this over a course of, say, 20 years while giving to charity, get deductions, all of those things. But there's a lot of complexity and expense behind that. And it really does not give you the flexibility that you may want. And that is where Tax Alpha shines. Because here I can tell you the truth that there is a fourth option. And it's one that could really diversify your concentrated position away while actually generating some tax losses to offset the gains in your portfolio. And what if you could customize your investment exposure to match your values while potentially creating what we call that Tax Alpha event, the additional after-tax return that comes purely from smart tax management. And that's exactly what this allows us to do. And it's been a game changer for Margaret, for David, for Linda. You see, let's try to go through this and explain a little bit about how this works. Once you understand it, you're going to wonder why more people aren't talking about this. You see, traditional investing usually works like this, that you buy a mutual fund or an ETF or sometimes even some stock. And you own tiny pieces of hundreds or thousands of companies over time, and the fund managers make the changes. And you don't have the control over your tax consequence if they sell something for a gain. You pay the tax on that gain, even if you've held onto those funds and they have lost money. Well, you see, the Tax Alpha flips this on its head. Instead of owning the fund that owns the stock, you directly own the individual stocks, usually somewhere between 200 to 500 of them, and it's really working to replicate the performance of, say, an index like the S&P 500. But here's the magic. Because you own the individual stocks, you can manage each position for tax efficiency. And here's how it works. Let's really dive into this. Let's go back to Margaret. Do you remember that she had her $2.1 million in company stock? But instead of selling it all at once, we transitioned it gradually into the Tax Alpha portfolio. And the fund itself is moving all of this stock in kind into the investment portfolio. So we don't sell. We keep her existing stock and is directly going into the new account without selling. So there's no immediate tax event. Then we use the cash position to build a diversified portfolio of individual stocks. And it tracks, like I said, the S&P 500 or some other indexes that we choose. But here's where it gets really interesting. Every single day, our technology is scanning Margaret's portfolio. It's looking for the opportunities to harvest the tax losses. And let's say that, well, Microsoft It's been doing well recently, but let's say it goes down 6% in one day, where the overall market was flat. In a traditional index fund, Margaret would have to ride that out. But in her direct index portfolio, we can sell that Microsoft position, immediately buy a similar technology company like Apple or Google to maintain her exposure, and then generate a tax loss that she can use to offset the gains elsewhere. So including the positions of some of these gains from her original company stock is what this is all about. Well, let me show you some real numbers. According to the research, that tax alpha can really potentially harvest 1.9 times more tax losses than traditional ETFs. And this base approach is over a 10-year period. And in one hypothetical example that I ran, a $1 million tax alpha portfolio generated $455,000 in additional after-tax returns. $455,000, and that's over a 25-year period, compared to just passive traditional indexing with an ETF or a mutual fund. Now, your results obviously will vary based upon the market conditions, your tax situation, and many other factors, but the concept is powerful, and we're using the natural volatility of individual stocks to generate the tax benefit while maintaining the broad market exposure. But tax alpha is just one benefit. Remember Linda, who inherited her parents' portfolio? She wanted to honor their legacy while being smart about diversifying with tax alpha. So we included other companies. Because her father had died of lung cancer, we took out tobacco companies. We could overweigh healthcare innovation companies because her mother was a nurse. And we could avoid fossil fuel companies because they cared about the environment and all the issues that are going on with that. But trying to do this with a traditional S&P 500 index fund, you can't. And here's another huge benefit, what we call the transition alpha. Remember David with his $4 million in appreciated stock? Instead of selling it all and paying that massive tax bill, we transitioned it gradually. And we might sell a small portion over time when we have harvested the losses to offset the gain. Or we might transition some of it in kind and use some of the tax loss harvesting on the rest of the portfolio to offset the gains when we eventually do sell. You see, this approach can actually potentially save tens of hundreds of thousands of dollars in taxes while allowing for a much more controlled strategy and a diversified process. Now, as we're looking into all of this, I need to be clear with you that some of this isn't going to be something you can do on your own with a do-it-yourself strategy, because the technology that's required to track hundreds of individual positions and monitor the tax loss harvesting on a daily basis is very unique, and you don't want to run into the wash sale rules, maintain the proper index tracking without the software, because it's going to be incredibly hard, and the software is sophisticated and designed just to do that. And that's why many family offices for high net worth individuals and families are investing millions of dollars in these platforms, and why until recently the strategy was only available for ultra high net worth individual families with $10 million or more. But here's what's exciting. What's made this technology available now to families like you and other families with starting with even say $500,000 or more in investable assets. But let me tell you how our three stories have turned out. You see, Margaret was able to transition her concentrated stock over 18 months, and it generated enough tax losses to offset most of the capital gains. Her portfolio is now properly diversified, and she's sleeping better at night because of that. Plus, the tax losses she harvested in the first year alone saved her about $40,000 in tax. Well, then there's David in his middle of the transition process right now, but we've been able to diversify about 60% of the position while actually generating the net tax benefit that he was needing, so he can be on track now to have this fully diversified within the next 3 years, while potentially paying less in tax than if he had held the original concentrated position. And Linda, she's been able to create a portfolio that truly reflects her family values while generating a consistent tax alpha. You see, last year alone, the tax loss harvesting strategy allowed about 1.2% of her after-tax return to grow. And now, you might be thinking, this sounds great, but why should I care about this right now? Well, there are several reasons why timing on this strategy is particularly important. You see, we're potentially looking at higher tax rates in the future. Now, as I say that, I am well aware that our president has just signed the new One Big Beautiful Bill and has kept the marginal rate lower for our taxes. But here's the thing, when we have all of these new, whether they're capital gains, whether they're working on different elements of net investment income tax, these are all still things that are holding true. And you may have thought that you could sell and not pay any tax on your capital gains, but now you may be paying 23% or 24%. And that's where this strategy is really helpful. So through all of these changes that we're looking at with the tax policy and government revenue that will be needed, there's a lot of experts that are actually thinking that tax rates at some point in time are going to rise. Now I say at some point, but that's on the marginal brackets. What if they actually start rising on capital gains tax? And that's what you care about. Those are the things that could easily rise, and the average taxpayer would never feel the difference because they don't own the stock the way you do. So we have to look into this on a more objective level, and they may likely go up in the future. And the tax loss that we can harvest today would be worth more in the future as our rates go up. Well, second one then. We're in a market environment where volatility creates opportunity. And the same market turbulence, maybe worrying you as an investor, can actually create more of the opportunities for harvesting some of these losses in this tax alpha portfolio. All right, third one then. You're sitting on that appreciated stock position. And whether the company's stock, inherited securities that you have, or just a concentrated portfolio that you've built over the years, the longer you wait, the larger the potential tax bill grows. But let me be clear about what this isn't. This isn't a get-rich-quick scheme. It's a sophisticated, long-term wealth management strategy. And this isn't about avoiding tax altogether. You see, we're going to follow every tax rule and regulation to the letter, but it's about being smart and strategic about when and how you pay those taxes. And this isn't right for everyone. If you're in a low tax bracket, or you don't have significant unrealized gain, and you're not comfortable with having hundreds of thousands of individual stock positions, this might not be the right strategy for you. But if you're a business owner, a retiree, or a high earner who has significant appreciation of stock and you want to diversify it, and you're in a higher tax bracket and you want to be more tax efficient, this is what it's all about. Having the control, the customization over your investments. And if you have at least $1 million in investable assets and maybe even $500,000 on the lower end, it's a way that you can have long-term wealth preservation and a growth strategy. That's what tax alpha might be worth exploring at that point. And here's what I want you to do. First, if you found this valuable, please hit the like button and subscribe to our channel. You see, we're consistently sharing strategies and insights to help you keep more of what you've earned and building over time for that wealth. But secondly, I want you to think about your own situation. Do you have concentrated stock? Have you inherited some or built it up over the years? Your portfolio has grown but isn't properly diversified anymore? Are you paying more in tax than you would like? Third, if you're interested in exploring whether tax alpha could be worth your situation, I'd like to invite you to schedule a complimentary second opinion meeting with our team. You see, this isn't a sales pitch. is a genuine opportunity to review your current investments and tax strategies and see if there's an opportunity to improve your after-tax return. Now, during this meeting, we're going to review your current portfolio and tax situation and run some preliminary analysis on potential tax alpha opportunities. And then we're going to discuss whether this makes sense for you and your specific situation. Then we're going to address any concerns or questions you have about this strategy. You see, this is going to be something that's complimentary. There's no obligation, no pressure, no cost to you for the initial consultation. We're simply here to help you make an informed decision about your financial future. Now, I'll say this, with only a limited number of families that we work with, because of this level of customization service requires a significant attention and expertise, we're selecting only a few to work with because we want to make sure that we can deliver that exceptional result. But if you're the kind of person who values a sophisticated financial plan, tax efficiency, and having a true fiduciary partner in your corner, I encourage you to reach out sooner rather than later. You see, I've seen too many successful people pay way more in tax than they needed to simply because they didn't know about this strategy. The tax code is complex and is getting more complex on a daily basis, but this provides the opportunity for those who know how to use it legally and the strategic tax alpha opportunity. But like I said, it isn't magic. It's just sophisticated portfolio management, and you and your family can be in the right situation to potentially save hundreds of thousands of dollars over the next number of years. So, if you're ready to explore whether this strategy works for you, click the link below and schedule your complimentary second opinion meeting. Remember to subscribe to our channel, and you can have insights that can help you and others that you care about to help build their wealth more effectively. Take care. For more information on taxes and investments, subscribe to our channel and click here for your next video.